Well, good morning. Welcome to our first EAM Global Small Companies webinar. We appreciate your effort and time you've made to be with us today. My name's Matthew Potter, and I'm part of the distribution team at SGH, and I'll be introducing the session this morning and running through the question time at the end. Please take note of the disclaimer on the screen. The presentation is general advice only, and we have not taken into account your personal circumstances, goals, or objectives. Prior to investing, we recommend you consult a financial planner and carefully read the TMD and PDS that can be found on our website. The information presented today is current as of today's date, the 26th of September, 2024, and be advised that the webinar today is being recorded. At the bottom of the screen, as the webinar is going on, you will notice a question box. Please do send your questions through to that question box, and during the webinar at the end, we'll be able to go through as many of those as possible. Any unanswered questions will be followed up post the webinar. Please also note there'll be a short survey at the end that will appear in the chat box. Please do fill it out. We do appreciate the feedback. And finally, CPD points will be provided for attending this webinar, and there will be a follow-up email with that connection back to that as well. So it's now my pleasure to introduce Travis Prentice, all the way from the US today, who will present Navigating Global Small Caps, the Power of Adaptability. Travis is the Chief Investment Officer and Portfolio Manager at EAM. He has over 27 years of investment market experience. EAM are a boutique funds management business located in San Diego, California. And since founding in 2007, EAM have specialized in small cap investing and developed an investment process that showcases momentum as the critical factor to include in portfolio construction. Today, Travis will introduce you to EAM and take you on a deep dive into why you should be adding the momentum to your portfolios, and particularly when adding to global small caps. We're excited to be partnering with EAM, and I'm sure you will find this session of great interest as well as very entertaining. With that, I'd like to say good afternoon to Travis. Thanks for joining us today.
Yeah, thank you. Thank you, Matthew. It's good to be here. And I just got back from Australia, being there in person last week. So happy to be on this webinar, and thanks everyone for your time. Yeah, so like as Matthew said, I think what I'd like to do today is just introduce you to momentum, why you should care about it, some of its misperceptions, get into small cap and why now is a pretty good time to be thinking about global small caps. And then we can get into a lot of the specifics of our informed momentum philosophy and process. So just want to give you all a heads up about what we're going to talk about. So without any further ado, and I'm glad we went off that one slide with my picture because it just reminded me that I have a face for radio, not so much TV. And I'm going to assume you're laughing at my bad jokes all the way through. I can't hear you, but that's what I'm going to assume in my mind. But first of all, I just want to give you a quick commercial on the firm. This won't take too long, but really our mission is to improve client portfolio outcomes through disciplined momentum investing. And so everything we built and evolved over my almost 3 decades in this business is really meant to harness the power of momentum to create results for our clients. We do that through a systematic approach that we apply uniformly across all our strategies that you see in the middle of the slide. And then what that allows, though, that approach is really persistent risk exposures through time, which gives you a bit more predictability and consistency in our outcomes. So that's the commercial of our firm. Now let's get into the fun stuff. If we go to the next slide, slide 4, I think the first question I'd like to answer is who cares, right? Why are we talking about momentum? Well, it turns out what we see from most investors as we talk to them is a lot of investors don't have enough exposure to momentum in their global equity portfolios. And why that's a problem is that it happens to be one of the best sources of excess returns in global equity markets. And so let me just tell you what you're looking at on this screen, because there's a lot of data here. But what we're doing here is just straight from Fama French website, the long-only factor returns of some of the major factors that you would have heard about in global equity markets. So momentum, value, growth, and quality. And so what stands out in this is basically that momentum outperforms, has the highest excess returns kind of across global equity markets relative to all these major factors, which with the exception of Japan, and we can get into that later, but generally speaking, momentum is a fantastic source of excess return. If we're just looking at value-added returns, or if we're looking at risk-adjusted returns, momentum tends to be and has been the best performing factor premium in global equity markets. And in general, in small cap, it's actually one of the best places from all across market caps and geographies. Global small cap is one of the best places to have momentum exposure if you're seeking value-added returns. And if we just zoom into that on the next slide, this is basically the same data, but we're zooming in on particularly the opportunity in global small cap, and again, comparing it to other major factors. So whether you're just looking at simple excess returns, risk-adjusted returns, information ratio, even the significance of the factor performance, momentum is a fantastic exposure to have, and it actually outperforms all the other major factors. So to be missing out on momentum, you're missing out on one of the best sources of excess returns in global equity markets. So that's why we should care. And when we talk to investors, this is one of the key things that they're looking at as they look at alpha satellites. You really can't do much better from a factor exposure than momentum. If we move to the next slide, I just wanted to point out, if you looked at that slide in the very beginning in terms of the major factors, what you tend to see with all factors is they tend to do better the smaller market cap you go. And momentum's no different. And so why that is, we think, though, is just the characteristics of small cap, global small cap in general. And so I think most of you know all this stuff, but look, the small cap market's vast, right? There are 11,000 companies to choose from. If you look at the cross-sectional volatility on the top right there, you can see in small cap, stocks act differently than one another. So as an active manager, you can put together portfolios that act a lot different than the index. The other thing is they tend to be less followed from an analyst perspective. And then you have 26% of the selection universe not even followed at all. So that creates some inefficiencies that an active manager can take advantage of, which culminates on the bottom right there is in global small cap, active managers have historically been able to add value. And again, I think it's because of these dynamics of the small cap market. But I think one of the things that we've all witnessed, if you go to the next slide, is small cap really hasn't done well lately. So I think, as a small cap manager, you have to be an optimist. But recently, I think there is a really good opportunity in global small cap just because of the underperformance that we've seen versus larger market caps. It hasn't been as bad in the non-US, but certainly in the US, it's been one of the time periods where small cap, if we look at some of these rolling excess returns, small minus large and mid caps, if we're looking at rolling 1 year on the left or rolling 3 years, and we look at the last 25 years, this is truly historic underperformance for small cap versus large. And so if we think about some of the macroeconomic factors that are happening now, interest rates have looked like they're peaking and actually going lower, as we saw the Fed cut interest rates by 50 basis points last week. And we've seen a little bit of green shoots. In fact, in July, we saw a pretty radical rotation from large to small. So we saw kind of a shot across the bow of what the market can look like as kind of the macroeconomics change. So that can, plus the fact that small caps underperform large by a historic margin and valuations for small are pretty attractive at the moment. You have a coiled spring really for small cap in terms of outperformance versus large as we kind of think about what's going forward. So we think it's a pretty good time to be thinking about small cap given what's happened in performance, but also kind of where we are in the macroeconomic cycle. And just to give you a little bit more on slide 8, just a little bit more on the small cap premium, because I think, we've seen it fade through time, and we're looking at US on the left, non-US on the right. It's been a little bit better in the non-US. But the one thing we like to point out to investors is that this is looking at all of the small cap universe, so the index return. And what you find is that the index is so broad, right? There's 5,000 to 6,000 companies in the global small cap index. So you do get a lot of dilution from just the sheer number of companies within that. And so if you just do a very simple active management proposition on top of that selection universe, if you go to the next slide, what we did here is simply just say, hey, in this period of time where small cap as an asset class has underperformed large and mid cap. What if we just do a simple buy small cap, high momentum, or buy the winners and don't care about all the other stocks within the index? And what you see here on the right is even in the US, where it's been dominated by large cap, if you simply just bought high momentum stocks or winning stocks and not the whole entire index, what you see is small cap with high momentum is actually outperform large cap. So this is another way of saying, active management is really important in small cap because it tends to get diluted. If you're looking for index exposure, all those companies, it tends to dilute the small cap premium. So we've done this research, but others have done research that suggests the same thing. Is like AQR Research Affiliates has said, own small cap but control the junk, right? So high quality. So this is just basically saying let's think about small cap and the small cap premium, not so much as index related, but what an active manager can add within that small cap universe. So what you're exposed to in small cap makes a pretty big difference. So moving on, all right, so we talked about momentum in terms of a good source, a standalone source of alpha, so a alpha satellite. But one of the other uses of momentum in a portfolio, it really has utility in terms of being a very good strategic diversification complement in your portfolio. And typically what momentum does really well is an offset to value. So we see a lot of the uses from our clients as offsetting their value bet. So momentum and value tend to be negatively correlated. They both have good return premiums over time, but they tend to outperform at different times. So putting them together and blending them creates a pretty good portfolio. The other way we see momentum used is either as a complement or an outright substitute to growth, because momentum and growth tend to be positively correlated. So you can use it as a substitute. Momentum actually has a better premium, as we can see on some of these slides, than growth does. And that's really due to the fact that growth, more often than not, means owning expensive stocks. And so the payoff to owning expensive stocks is not always fantastic. In fact, over the history, it has been a bad premium to have it returns negative excess returns. Now, I know we're not saying that all growth managers can't outperform, but we're saying most of the ones that outperform over the long term are either exposed to momentum, value, or quality. So we would say, hey, let's just go to the source of value added returns, and that would be momentum. The other way we're seeing momentum used is a complement to quality. And so we did a long research paper on that, and we'll get into a little bit more details on the next slide. But one of the uses of momentum, and you can use it throughout market cap. So if you have value exposure, you have quality exposure, momentum is going to complement those really well and create a bit more of an optimal return stream within global small cap. So momentum has a very strong case to be made just as an alpha satellite, but also a complement to other styles in your portfolio. So I wanted to zoom in a little bit on how quality and momentum kind of work together. And I'll just say as an aside, you can always go on our website, and we have a long form version of all this research that we're sharing with you today. So if you can't sleep at night, please go to our website and read the 46 pages we have on this, and you'll probably get to sleep pretty quickly. But yeah, looking at kind of the dynamics between momentum and quality, why they're kind of a good pairing. If we look at the long-term correlations, it's interesting that for the most part over the history, momentum and quality have tended to be positively correlated, although mildly so. In the recent past, it's actually gone pretty negative, and that's what you see on the global small cap, momentum and quality rolling excess return correlations on the bottom right. Look what's happened recently. It's pretty amazing that momentum and quality have diverged a bit. And if you look at the left side, the bottom left, and we kind of look at the history and the dynamics of momentum and quality, quality in the gray, momentum in the green, what you can see is there's been a pretty divergent return between momentum and quality recently. And if we go back in time, it kind of rhymes with history. Generally, you see momentum and quality diverge at kind of these regime shifts in the marketplace. So in the late 90s, when the internet build out was happening, and now kind of similar to what's happening with AI, it's just the fact that it seems to be the market's being led in global small cap by not so much quality companies, but maybe more emerging technology companies that don't kind of screen well from a profitability perspective at the moment. And so what momentum can do in your portfolio, if you already have quality, is it provides a bit of upside insurance when the market regime shifts like that. As you can see, momentum kind of gives you that upside participation where kind of quality kind of hugs the market and gives you a pretty good return. It's kind of that ballast, the stability in your portfolio. But momentum, again, provides that upside insurance as far as we can tell. So we've talked about the momentum premium, all the great things about it. And so the natural question is, well, how come I don't hear about it more often? And so now I kind of would shift gears and talk about kind of the reasons why, some of the misconceptions, misperceptions about momentum. Again, there's three main ones. The first one is what you're looking at on slide 12 here. But there tends to be a confusion in the marketplace that momentum and growth are kind of synonymous. They're the same thing. And it turns out they're very much different, right? Because momentum, just philosophically, is always going to what's trending, what's working, kind of irrespective of the style box that companies get put in. Whereas growth is going to reorient to high growth rates and more often than not expensive. And so what we are showing here is just the difference in outcomes with momentum and growth as a style. And so what you see on the top right there is the kind of the average 3-year correlation through time. It is positive, but look at all the variation around the mean. So there's times when momentum and growth are very much friends, and there's times where it's very much opposite. And it turns out when momentum is not growth, which is what makes the difference in terms of the return premium. So it's really the adaptability of momentum, which gives it that long-term benefit over and above what you get from a growth exposure. And you can really see that in the comparison of momentum and growth through time on the left there. You can see when growth does well. So when growth has momentum loads on growth. And so you can see that when growth has a big run, momentum tends to be there and actually outperform. And so what we did is we zoomed in on kind of this development in the late 90s on the bottom right there, the technology bubble bursting. It just give you a reflection of how momentum adapts through time. So look, as you can see in the late 90s, momentum and growth kind of moved together. So momentum subsumed growth because growth is where the trend was, growth is where momentum was. But then when the bubble burst, you can see that momentum did get hit alongside growth, at least in the short term. But you can also see how growth went well below the market excess return, so a negative excess return, and stayed there for a while as momentum shifted to what's working and away from what's not working, in this case, growth, right? So it's when momentum is not growth, which makes a tremendous difference in the long-term payoff structure. So momentum as a discipline is always shape-shifting, right? It's moving to what's trending and away from what's not. And it's really that adaptability is the reason why we think momentum is a good source of value-added returns over the long term. It kind of tends to cut off the big, deep valleys of growth underperformance. So participates in the upside, but kind of cuts off those big valleys of downside. So that's kind of a misconception number one that is kind of easily refutable. I mean, the second one is probably the main one that we hear in terms of momentum investing. It kind of has this negative connotation of being overly risky. And so what we did here on slide 13 is we just compared it to value. Now, any source of value-added returns is not without risk, right? It's just different kinds of risk. But value tends to have a positive connotation. When you mention value, it's like, oh, these investors are smart, it's not risky, we're buying cheap stocks. But it actually turns out that value is pretty risky as a strategy. And so just from an objective perspective, we looked at different measures of risk that you see on the right there. So volatility, beta, drawdown analysis over long periods of time. And what you see is basically that momentum is at least as risky as value, if not less risky than value. So if you're comfortable with a value bet in a portfolio, then you should be comfortable with momentum. So from a purely objective perspective, momentum isn't overly risky. It's actually very comparable to value in terms of that kind of excess return risk. But the reason why you kind of get this momentum is risky connotation is actually how momentum underperforms. So when it does, it's just different than value. So if you go to the next slide, we think part of the reason why investors think it's overly risky is, well, number one, it's just how momentum underperforms. So momentum tends to underperform in very short, sharp, sudden corrections so that you can't help but notice. Whereas value tends to underperform It's like a death by 1,000 cuts, right? It's like it accumulates small underperformance through time, but accumulates as a big underperformance sometimes that lasts for a while. But then you get a big bolus of excess performance, right? You get a year or 6 months of just tremendous performance. So the price of values outperformance is patience, right? You got to be patient to get that payoff. Where momentum's totally different. It tends to tick around and add value month by month, and then you have a short, sharp, sudden correction that you can't help but notice. And so that's the reason we think that it gets this negative connotation of being overly risky when the objective facts don't back that up. It's just the nature of how it underperforms. But the other reason why people think it's overly risky is just to the academic research of momentum. And this is what's displayed on 14. So we do long-only momentum, right? And a lot of that research that we shared is basically the returns the long-only factors, so long-only momentum. It turns out, but in most research papers that you read on momentum, from an academic perspective, they're talking about the momentum factor. And that's a long-short factor. You're long the winners, you're minus the losers, or what's called WML. And it turns out that the momentum factor itself, not long only, but the factor itself, is really what's responsible for these big drawdowns. And so what we did in this slide, there's a lot of stuff here, but if you look at the left side, histogram and probability density plots, what we're pointing out is the top one there is the momentum factor. And you can see that non-zero probability of having a pretty extreme left tail event, right? That's not good. But look at the middle, long-only momentum. So that would be like what we do. You can see the tail events are much, much different, right? It actually looks pretty attractive, a little bit more of a right tail than a left tail. But then look at the bottom. The bottom is the loser portfolio. So what the momentum factor is short. Now, those stocks have a non-zero probability of crashing upwards, right? A big right tail. So it turns out what's driving this perception of risk is actually the factor, and it's driven not by what you own, but it's what you don't own. And so generally when momentum has bad performance or has a correction, and this is what's depicted on the right side of the slide, is that generally momentum underperforms not in a down market, it actually outperforms in a violent up market where that loser side crashes upwards. And so what you're seeing on the right there is just we took the worst months for the momentum factor of all time, and we kind of looked at the returns. You see the market return is generally in a big up market, right? 16% in 1 month. You can see the long short momentum factor is down 23% excess return. That's really bad, right? But look at the winner side. So the winner is kind of what we do, long only momentum. That's 13, you're up 13%, market's up 16.2. Yeah, not so good. You lost 320 bips. But look at the loser side, up 36%. Now, that loser portfolio tends to be value, and that's why value is an outstanding hedge to momentum. And so we looked at it, and it's over 75% of the time, if you have a momentum and value pair in these worst months ever for momentum, you actually added value. So when momentum underperforms, it tends to be after a market decline and in the early stage of a market rally. And that's generally comes in an up market. So it's a little bit better than what most people perceive in terms of when that underperformance occurs. The last pushback we get, and look at that, we're right on time with these slides. The last pushback on momentum, I think, is very valid. I think this is probably the most important true pushback to momentum investing, and that is it's difficult to do in practice. And so, from taking it from an academic theory to actual real world results is hard, right? It's simple in theory, but it's actually very difficult to do in practice. And the reason for that, the primary reason for that, is that momentum, the factor, while it's persistent through time, it's robust, it's pervasive through market caps, geographies, it does decay quite quickly through time. So what that means is, if you look at the left side of the slide here, so we went back in time about 30 years or so, I think, in this data, actually almost 40 years. But what we did is we created all these momentum portfolios, purely academic momentum portfolios, and we varied the length of holding period to really get a signal decay through time. And what you see is momentum's a very powerful source of excess returns, but after about 9 or 10 months, if you don't turn the portfolio over, it actually goes against you. So what does that mean? Well, it means that to really extract the momentum premium in practice, rebalancing frequency, how you rebalance, why you rebalance, trading costs. If it's not done well, you're actually not getting the momentum premium. And if your trading costs are too high, you're actually going to erode the alpha through that implementation. And so on the right side of the slide 15, what we're looking at here is basically how different rebalancing periods impact results. So generally speaking, the more you turn over, the more you rebalance a momentum strategy, the better the outcomes. And so really the trick from bringing this from theory to practice is basically how do you preserve kind of that monthly alpha that you see in the monthly rebalance version, but do it at a turnover rate that can be associated with extracting the alpha and not eroding it through your trading costs. So all these things, all these realities of momentum is why you don't hear it as much, because it takes extreme discipline. It's an everyday type of thing. And that is really where informed momentum comes in. So what we built, what we've evolved over almost 30 years is really meant to take this kind of theoretical opportunity of momentum and actually translate into real world results for our clients. And so that's the one that really sticks out in terms of a criticism that's fair. And so while it's easy in theory, it's very difficult. And that's where informed momentum comes in, which is kind of the segue we're going to make now in terms of what we actually do to elevate momentum, right? What we take the academic versions of of momentum and the exposure and actually have a real world type of results for our clients. And so it starts out, there we are. It starts out with philosophy. What do we believe in general? And so when we talk about momentum, I think it's important to point out that, yes, we invest in companies with positive momentum. But when we talk about momentum, we're also talking about businesses that are doing well. So we actually think the purest expression of momentum is the stock price outperformance signaling something happening positively at the business. So from a philosophical standpoint, there's really three things we believe in. One is that momentum works, and we've kind of shown that empirically. But secondarily, momentum works better with rationale. And then lastly, momentum continues to work with proper risk management. So that combination of starting with what works, momentum, elevating a bit with rationale, and then managing risk, every day effectively is what we refer to as informed momentum, or how you really harness the power of momentum to create real world results. And so from that basic philosophy comes the process. Yes, as you can imagine, we do have a process. It's systematic in nature. And this is how we literally translate that opportunity into results. And there's 4 stages. And I'll go kind of quickly through this, and we can get into as much detail as we have time for in the following slides. But the first area of our process is discover. And this is where we're reducing the selection universe effectively by capturing momentum signals. We do it every day, country by country. The next phase is analysis, where we're really eliminating false positives that may come through the process, but really focusing on the best ideas. So ones that have very strong business rationale, why that momentum exists in the first place. The next phase is challenge. And this is where we're maximizing alpha, managing risk at a stock by stock level by driving the portfolio to strength and away from weakness every single day. And then lastly, execute is where we're preserving alpha through low cost trading. So maybe I'll step through some of these stages real quickly to kind of differentiate from kind of the academic side or the purely quant side of momentum to what we do. But it starts with the selection criteria, right? The discovery process. This is where systematically culling the universe and focusing on momentum signals. And what you see in the middle of the slide are the signals that we use. And so what you'll see is it's a little bit more holistic, more signals than just your standard academic, 12 minus 1 relative strength. Obviously, we care about momentum and the scores of momentum. So we want to see improving price momentum. We want to see that improvement coming on increased trading volume. We also have other price-based signals like recent new highs in price, so 52-week high, relative strength achieving new highs. But we also have fundamental momentum signals like positive earnings surprise and positive estimate revisions. The reason why we have a more holistic view of momentum is, in fact, that if you look at all these signals that we're capturing, they're more predictive of outperformance together than standard price momentum alone. And in fact, if we're just looking at ICs or high predictability, the single best predictor is actually recent new highs in price, which sometimes is counterintuitive to what most people think. But the reason we believe it works so well is because if you think about from a psychological perspective, no one wants to pay the highest price for a security over the last year. So everything else being equal, those tend to be systematically undervalued. But that one has the highest IC of all of them. But all of these combined have a higher IC than any one of them alone. And so really what moves from discovery into our analysis part of what we do is really the number of signals present, and the strength of those signals is how we prioritize kind of the research list of the team. And so in the next phase, what we're doing is basically 3 areas of research, but I would say that this is how we elevate momentum, but we have to be very efficient and quick in our analysis, because if you go back to that slide with the signal decay, to be a good momentum manager, you have to get the stock in the portfolio if it meets your criteria, because most of the return comes in the early stages of your ownership, and it's all gone by about 9 or 10 months, right? So you got to be efficient in your analysis. And here we're shifting the odds in our favor just a little bit more. We're eliminating false positives by doing targeted analysis on 3 key areas, right? One is we want to understand why that momentum exists, so verifying the rationale behind the momentum. We want to see the financial impact from what we're finding on a rationale, so improving financial performance. And then lastly, so we want to uncover some evidence of mispricing. So from a rationale perspective, what we have seen that works the best within momentum securities is very clear reasons why this company is outperforming. So we see 2 key areas that give you a bit more of a duration of outperformance and amplitude of outperformance are companies that are innovating or they're reinventing themselves. So when we talk about innovation, we're talking about launching new products, new services. Reinvention would be new management teams, transformational M&A, improving market dynamics, but something we can clearly and easily identify that are the real reasons why that momentum exists in the first place. And so what happens though with this strategy, the reason we believe momentum actually outperforms is due to investor behavior, right? So generally in the beginnings of trends, when there's new information, when there's something happening at this company, investors tend to underreact to the positive nature of this information. So at the beginning of a trend, there's an underreaction, and how momentum pays off is at buy point, it's underreacted to, and then ultimately over time, as that company executes, then there's an overreaction to current trends. So that's kind of the dynamic that we're exploiting through what we're doing and through the analysis that we're doing, is really identify that kind of undervalued new information, on the precipice of accelerated growth, improving financials, and then we anticipate those companies to be overreacted to, and that's when we're exiting. And which brings me to the challenge part of what we do. So momentum done well, we believe, is a kind of hand-to-hand combat, trench warfare every day, bringing your coffee and your lunchbox in and just grinding out the process. And this is really comes to fore really in our challenge phase. And this is where we're doing every day, continually through time, to manage risk and maximize alpha. And we're just moving the portfolio to strength every single day and away from weakness. And what that allows us to do is, because we have that idea engine running all the time from a discovery process, so it's very easy to be very disciplined on the sell side. And what we're doing is basically we understand we want to keep the portfolio fresh, we want to be objective, but we also want to get rid of losers quick. And so from a sell discipline perspective, we're very objective, right? If we see any deterioration in momentum, we see a violation of uptrend, any deviation from initial thesis, any negative earnings surprise, negative estimate revisions, we move on quickly. So momentum's a discipline of finding the winners and allowing your big winners to drive performance, and at the same time cutting your losses quickly and identifying those mistakes early, so that kind of upside downside capture is favorable through time. So that challenge phase is really important in terms of that aspect of having that daily discipline. And so when we talk about rebalancing, actually, we're not a black box investor where, we rebalance based upon a calendar, right? A month or a quarter, one day you make wholesale changes in the portfolio. We actually rebalance stock by stock every day based upon the signals that we're capturing, the signals that we're seeing. And because of that, we tend to get earlier on in trends and we cut the losses quicker, right? Because we're moving based upon the signals. So a typical day for us, rebalancing every day would be, we're buying the new stock, we may be trimming an exposure of an existing holding, or we may be selling one position, right? So it's stock by stock every single day based upon the signals. And so what that means is that we think we generate much more persistent risk exposures through time and capture more of the upside and less of the downside because we're willing to act on a daily basis. Which brings us to the trading costs, which is extremely important, right? And this is where a lot of momentum strategies can fall down, is that you need keep the portfolio fresh. You need turnover to really extract the premium. And so your trading costs better be low to preserve alpha. And so what we're showing here is basically the results. So this is third-party data. We use a service called GTA that measures our performance in trading versus our peers. And what you can see is we're looking at both explicit and implicit costs, but implicit is you generate your biggest ones, right? Like market impacts, you generate your biggest cost. And so when we look at our market impact peer rank versus our peers, we're in the top decile, and that's not the good side, right? So we have some of the lowest costs versus our peers. You're actually in the marketplace. So preserving alpha through low cost trading is extremely important. We measure it, we evolve it, we make sure we're delivering it, and certainly the results back that up. One of the other ways I think a momentum strategy can go wrong, if you turn the slide, is not managing risk at a holistic level and not having the persistent risk that you're compensated for. So we also look at risk from a kind of holistic perspective. We use Axioma's risk model to do it. And really the big risk to momentum is things work till it doesn't, right? So if you have all your exposure in a couple baskets, like from a country or industry perspective, that can really work against you in certain times. And so what we do from a risk management perspective is we have limits in place, guardrails in place for country risk and industry risk. We look at it in terms of a contribution to active risk, and we want to limit those country and industry risk to 20%, because what that does is then make sure that your intended risk, your compensated risks, and for us, that's informed momentum or momentum plus stock-specific risk to be the vast majority of the risk in this strategy. And you can see on the bottom right pie chart that since inception of this product, it's been almost 70% of our contribution to active risk has been what's intended, right? Momentum and stock specific. And that gives you that consistency, that repeatability, that predictability through time. And you can see that on the left side there, that's just showing you through time, how persistent this risk exposure is in our strategy. So again, that's where you get a little bit more of a consistent, predictable return stream. One of the things that people get surprised about is our team is on slide 24. And generally you see it earlier on in presentations, and we do this for a reason, because the process is bigger than any one of us. And I think to have momentum, to do momentum well, you kind of have to be egoless. You just kind of have to drive a process and not get attached, not be emotional, all those things that can get in the way of results for your clients. So if you think about our team, we're all generalists. We all work together as a team, and we just drive the process. Very much a blue collar work ethic ethos, right? It's a lot of grit, a lot of grind, but we love it. So that's why we put it on slide 24, is the process is bigger than any one of us individually by design. So I know we're kind of running up against the time here. We have I think we are trying to get this done in the next 5 to 10 minutes so that we can have some time to answer any questions that come up. But maybe one of the things that we can focus on is, well, I guess slide 27, because however good your process or philosophy you might think it is, you might want to occasionally look at results, right? So this is just a summary of kind of the typical performance and risk statistics, and this is looking at the global small strategy since inception. And you can see obviously good alpha, but I think one of the things that surprises people is the upside downside capture, with this strategy, and momentum done well should look typically like this, where you participate in those up markets. So up market capture, greater than 100%, but then down markets, we're adding value as well. And so it's not so much uptrending or downtrending market which drives our alpha. It's really about the volatility, or if we're seeing return reversals in the marketplace. Return metrics through time, which is why it's a fantastic, alpha satellite for your portfolios. The other thing that maybe we can hit on, because I I think one of the true benefits of having momentum in your portfolio is its adaptability. And if we go to, I'm gonna try to get to the right slide. But if we look at, where we're finding momentum, that's slide 34, from a country or industry perspective. I think the key thing to understand about a strategy like ours is it's really effective as that kind of lone alpha satellite global small cap, because if you think about momentum as a discipline, it's going to go wherever the trend is, right? And so it's going to exist kind of outside of that rigid style box. So, we don't know what's going to outperform going forward. It could be highly profitable companies, so quality, it could be value, growth, who knows, right? And so if you're going to pick one, I think the power of adaptability is something that is undervalued, I think, when people look at investor portfolios. And the reason we love momentum and the reason why we do it is it's adaptable through time. So we'll just go wherever the trend is. So if the market's led by any one of those things, you would expect momentum to pick up on those, right? So it's a nice pressure valve, if you will. It's going to move across rigid style box and really be primed to add value, kind of no matter what the cycle may throw at you. And so where we're seeing momentum, and we're looking at our portfolio, by country, and we're looking at by industry, but you can see there's a lot of movement through time. So you're going to see us move to wherever we find the strongest trend. So right now, where we're seeing the strongest trend, and this is a little bit dated because I think we're looking at, what is this, 630 data, I believe. I can just tell you what's happening now is we're seeing, since about July, when we saw that surprise CPI data and the Fed move, we're seeing a bit stronger momentum in the US, but from sources that are very different than what we've seen in the past. So we're seeing actually real estate have very strong momentum, very early, strong trend. Financials, regional banks for the first time in a long time. And so I would say, though, that you got to remember, we're looking at everything from the bottom up, so we're not making top-down predictions. But this is just where we're seeing the strongest momentum. Less so in Japan, given what happened in August, the yen carry trade, that was the unwind was a little hurtful to Japan. We're seeing much stronger trend in emerging markets at the moment, but really all that's India. India is very strong. It's been a source of just extremely strong momentum and trend for some time now, but it continues unabated. And really across sectors and industries within India, we're seeing very strong trends. From a sector perspective, we're seeing some movement, a little bit less so in industrials and information technology, because we're seeing really across the world a very pretty strong differentiation in terms of AI. So before, this most recent period, it seemed like every company that mentioned the word AI just ripped, right? Very strong performance. But now we're seeing a little bit of a differentiation between companies that actually have a business with AI. So in general, you're seeing industrial and technology come down a bit, healthcare, biotech up a little bit, financials and real estate up as well, as we're seeing some pretty strong opportunities in the US. But I would say just overall, you're going to see a lot of movement in what these exposures look like through time, because it's just going to reorient always to the strongest trends we're seeing globally. What else can we talk about? We have the characteristics on slide 35 of the portfolio. And you'll see that, by design, really from a holding perspective, it's really about the process driving results, not a handful of securities. So you're going to get momentum, you're going to get diversified. But we're obviously we're not benchmark huggers. We're very different than the index. As you can see, the active share is very high. And then our top 10 is going to move a lot in terms of just what's actually outperforming, what's working, tends to be higher weights. We don't really conviction weight our holdings. We have a very strong conviction in our process, not in any one or two holdings. So you're going to see a lot of movement in our top 10. But just looking at it as of 6:30, it's pretty fun to see some of these trends in here, right? Because I think momentum as a discipline, it tends to be multi-thematic, right? The difference is that you don't have to predict the themes ahead of time. We'll be in themes that are working, and they're working now, right? So if you look at this top 10, I think it's interesting to see, like the FTAI Aviation, right? They lease aircraft engine and parts, and they're really benefiting because Boeing can't seem to produce a jet. So there's a strong demand for replacement parts and leasing of engines. There's been a big trade down in terms of the consumer that we see across the world, but really in the US, probably most acutely. where just the inflation fatigue is changing behavior. So we're seeing a lot more eating at home. So Sprouts Farmers Market's a grocery store. So eating at home more often than going out. And then if you go out, we're seeing a very strong trade down effect. So Wingstop's a restaurant chain in the US growing rapidly, but they sell chicken wings. So not the most expensive place to go out to eat, but they're really driving results now. So yeah, we're seeing this kind of trade down effect really impact consumer behavior, and you see it kind of in our top 10. And then, HD Hyundai Electric, they make electrical transmission equipment, which is obviously more important as AI is consuming all the electricity in the world. So yeah, whenever you see our top 10, you're going to see movement, but you're going to see a lot of kind of big trends that we're finding in the marketplace. So just kind of mention that, and look at us, we're done in about 15 minutes to spare.
Well, perfect. Thank you, Travis. That was excellent. I was really interested as you were talking, just thinking through the dynamic of the discussion, and there's probably a few key points to draw out. Why invest now? Why global small caps and why invest now? I think global smalls, you obviously showed, are at a discount to large caps, which is a very good start. Momentum works as a factor and adds value. I think that's very clear. But informed momentum shifts the odds to do even better. So that's a very good starting point as well. But then looking at global smalls, once again, it's very inefficient compared to the large cap cohort. And as we all know, inefficiency leads to opportunity. So when we're thinking about the concept of why invest now and why EAM, Travis, is there any other point that you'd like us to bring to the conclusion of that presentation today?
No, I would say, look, if small, it's been kind of a broken record of saying small cap's going to outperform over the last, 10 or 15 years. It seems to be a kind of recurring theme. But I would say at any time, if it's not going to work now, then who knows, right? Because it's so primed to outperform now. And I actually think that from just a diversification standpoint, we're seeing extreme levels of concentration in large cap, right? Particularly in the US, but globally. So more and more of the market return has been driven by just a few number of stocks. And so I think from a diversification perspective, I think there's a good argument to make in small cap. You talked about active management, but really small cap is a coiled spring right now. And I think the thing that's starting to unleash this coiled spring is the interest rate cycle, right? That's been on the high interest rates have been kind of the boot on the neck of small cap. And so, we're seeing a little bit of the green shoots, I think, because of the cycle. And so I think small cap's primed to outperform, and it could be pretty violent, just given where the underperformance versus large has been. And then obviously with the interest rate cycle.
Excellent. Travis, you've been in the market in Australia now for over a year. So can we go back to slide, I think it's 31? Just be interesting, is it possible? It'd be interesting to see the performance of the strategy in Australia, but also the longer term performance. I think that would be interesting. You might have just noticed the Q&A pop up on your screen, the survey, sorry. So do take a moment to fill that in as we're going through this. Yeah, Travis, would you like just to give us a bit of colour as to how the fund's been going in the Australian market and also over the longer term?
Yeah, over the long term, obviously pretty strong results since inception. We came out of a pretty difficult time period for our style, kind of in the 18 months or so, around 2000, middle of 22 to 23. And that was kind of historic underperformance for momentum as a style. But generally, when we've seen that in history, they tend to be short-lived. They tend to cluster around some volatility events, and certainly saw that with interest rate cycle and predictions and movements. But every single time in history, when you go through those tough periods, you generally get a very strong period of performance coming out. And that's kind of where we are now in terms of this year to date. It's been very strong for the strategy. So, I think the message here is that it's doing exactly what we would have thought, and the market environment now has kind of come back to our style, and then we're getting paid for that.
Oh, fantastic. Just to make the point, the white section on that table is the Australian-based portfolio performance, and the blue box is the longer-term EAM performance since inception. And the dotted line on the performance chart is the long-term performance from day one, and the solid piece is the Australian-based performance just on that chart. So fantastic. We have got a few questions coming through. One's just on the importance of speed, Travis. So as information is coming into the market and you're doing your research, how important is it to be quick with that research? And how do you manage to actually react quickly?
Yeah, I think our research on that signal decay, we called it the quick and the dead, and I think that's very true in momentum. You have to be efficient if you're going to do it well, and you're going to extract the momentum premium. So I think you got to be efficient, but you got to be effective. And I think the fact that we've been doing it for so long, right? We've been managing momentum strategies for about, almost 3 decades now. There's a tremendous amount of pattern recognition that comes into play, both on the signal side, but on the analysis side. So we've seen these kind of stories before, and we know exactly what to look for. So that experience and that focus of doing one thing for so long, that really gives you efficiency, but it also makes you're more effective in your decision making. So we got to be efficient, we got to be speed, and we got to be accurate in our analysis. And I think it's just through experience and evolving a process that allows us to do that effectively.
Right. Another question was just on the frequency of rebalancing. It's obviously an important part of the informed momentum approach. What is your sort of target turnover, not target turn, what is your target process for changing portfolio positions?
Yeah, Matthew. I mean, so generally, if you want to extract the momentum premium effectively, your holding period is going to average like 6 to 9 months. Somewhere around there is kind of the perfect time, and so your turnover rate is going to reflect that if you're doing it right. But when we rebalance, I think we said earlier, we're balancing stock by stock every day. So we're not making wholesale changes on the portfolio every day, but we're incrementally making changes based upon the signals of our portfolio and the new ideas that are coming through. So we tend to move quicker than, and more effectively, I would argue, than your kind of black box, naive academic momentum that rebalances maybe, once a month or a quarter on a specific day where they're moving, 20% of the portfolio. We think there's more optimal times to make those changes. And the only way we know how to do the most effective way to do it is to do it stock by stock based upon the signals. And having that commitment to do it every day captures more upside and limits the downside.
Right. You mentioned some of the junk end of the market, and that can rally in the short term as the market recovers quickly. What stops that becoming a momentum signal for the fund, a poor performing stock?
Well, I mean, I think, you got to be careful on how you define junk because things can change rapidly. So I would say that, so when we talk about momentum and momentum signals, we're talking about medium-term momentum. So, and not to get too complicated, but we have a 12-month momentum score, but with a little bit more weight on the most recent 3 months. And so what that means is that you can have a short-term reversal in a company that, is not doing well, for whatever reason, could be short covering, whatever. And you could have a big pop, big change in momentum, but not a change in medium-term trend. So we'll move the portfolio if things have changed at the business fundamentals and we're seeing momentum and we're seeing trend, but it has to be more than like, a couple days or a month or something like that. So we're measuring trend medium term, but the business also has to be improving. So that is kind of how we'll move from cycles, because sometimes that losing stock or that junk stock is not performing well because the market cycle, but things change, right? So you got to be really open to where that change occurs and where that trend comes from. I don't know if I answered that question, but
yeah, I think you did.
Maybe within somewhere I was talking that it made sense to somebody.
No, I think at the end of the day, it sounds as though that's the critical piece about the informed momentum solution, is that momentum is momentum, but there's a reason things go up and down. And if you can identify why it is, your positioning of the fund is much more powerful than just relying on the fact something looks like it's going up or down.
And I would add to that when we're doing our analysis and we're looking for rationale, that's called, what we would say that the output is idiosyncratic drivers. So we don't buy securities just because interest rates have gone down and banks are, poised better or what are capital markets or whatever. There has to be something idiosyncratic that we identify that's driving the results of that business. So it could be an interest rate sensitive sector that has momentum, but when we select a security for the inclusion in the portfolio, there has to be some kind of idiosyncratic company specific driver. So that helps from a long-term perspective of not having those reversals on you. That momentum sometimes has, right? You can go up and then it can come down. The ones that endure a bit longer and give you more upside are momentum securities that have really good reasons why that exists.
Well, that's great. Well, thank you very much, Travis. It's been a really insightful session today. And as Travis has shown, the fund has been available in Australia for over a year now. And we have got some ratings and we've got some platform approvals as well. As you can see, there's Hub 24, Premium. We've got a number in the process as well. So we're talking with BT Panorama and we're talking with Macquarie. So if you do have any interest in getting the EAM solution on those platforms, we'd love your support. So if you can send a pledge through for EAM to go on Macquarie Wrap as well as BT, that would be super helpful for us. Ratings, we've got Zenith recommended, which is great. And Lonsec recently just gave us our first rating, which is an investment grade, which is fantastic as well. Also, if there's other platforms you'd like us to look at and get availability on, please just talk to the team. The team there, they are following slide. You can see the broader SGH distribution team. Any questions or follow-up, don't hesitate to contact them. You will notice a QR code at the top right of that screen. By clicking on that, you can access the fund page for EAM, and that will give you access to all the resources on that page, including some white papers on momentum investing, which you might find to be, or I'm sure you'll find to be interesting. Well, so that brings us to the end. The survey is there to be used as well. If that is helpful, we'll send you a copy of that. Thank you once again, Travis, for making time to be with us from the US today. We really appreciated your time. Thank you again for the audience for participating and being online. May the force of momentum investing be with you. And we look forward to meeting up with you soon. So good morning.
Thank you.
Thanks, Travis.